Turkey's lira took yet another dive on Friday, plunging 8.5% to 6.3 against the dollar before a slight recovery. It happened after the US warned more economic sanctions were on the way, unless Turkey hands over detained American pastor Andrew Brunson. The fallout with the US is partly why the lira has lost nearly 40% of its value this year.
We shouldn't make concessions. The US is far away, but it wants to show its political strength in this region. Therefore, there's not much we can do. Let's keep up the resistance.
On Thursday, Turkey's finance minister sought to reassure investors, saying Turkish banks would emerge stronger from the crisis. Not all analysts were convinced.
In the near term, what we have are Turkish companies that have borrowed in foreign currencies and are now going to have to service, therefore, a materially higher charge for their debt. And that's going to be very painful. And, of course, that will knock through to the banks.
The lira's struggles have investors worried about a possible knock-on effect for emerging markets. It brings up memories of Asian financial trouble in 1997 and Turkey's own 2001 crisis. Those shadows of the past have led to a wave of selling across emerging market assets this week.
I would say we're not heading for a 1990s crisis because we don't have the risk of contagion from Turkey, which we had within the Asian tigers in the 1990s. That said, I do think that tighter global credit and liquidity conditions will be damaging for emerging markets writ large.
Deep concerns remain for Turkey's economy, particularly whether Turkish firms can afford to service their debt. Despite that, Turkey's President Erdogan is defiant, calling on Turks to sell their gold and dollars for lira as part of an economic war.